It gives me great pleasure to bring on board Mr. Sumant Kathpalia, Managing Director and CEO of IndusInd Bank. Mr. Kathpalia, it's your first time on ET Now and first time we are interacting on this forum. So a very warm welcome to you.
Thank you, Nukunj, and thank you for inviting me to your show.
Mr. Kathpalia, before I get into specifics of IndusInd Bank, just about every brokerage strategist or an economist I've interacted with post-budget, they have one simple understanding, which is that a fresh investment cycle has picked up. This is going to be a big year for corporate banks and for the credit cycle. Is the optimism justified? I want to hear from a banker. So far I'd heard from the economist and the strategist. Let's hear from a banker.
So I think the budget has fueled growth ambitions, and I think it's a pro-growth budget, and I think within the constraints, the finance minister has done a fantastic job of giving impetus to growth. In my opinion, if the productive spending happens in the infrastructure and the health, there is no reason why growth will not come back. And I believe that the country is pivoting towards growth. We've already seen it, and we thought, is this sustainable? Is it pent-up demand? In my opinion, I think the growth will be led by consumption. The growth will be led in the green, and some greenfield projects will start coming in Q3 and Q4 of this year. So I think corporate banks are back. I think good corporates will start getting new projects, and we are very, very gung-ho on the corporate banking also.
Corporate banks are back, but is IndusInd Bank also back? Because the data is indicating that things surely have bottomed out. Overall slippages were at 1.2%, restructuring book is capped at 1.8%. Have the worst COVID write-offs, have they bottomed out?
So if you look at our Q3 results, and if you look at the pro forma numbers, we have tried to take everything into account. There may be minor slippages in Q4, but they're not going to be of the same extent which we saw in Q3 in the retail side of the business. And please remember, during Q1, Q2, there were no slippages in the corporate side, in the retail side. On the corporate side, we used Q4 of last year, financial year, Q1 of this year, to take as many provisions as possible. And I think now we find our corporate book to be very good, and I think whatever had to be put on the restructuring, we put it. It's awaiting the one-time restructuring approval, and we have to see whether that gets through. And I believe that the worst is behind us in corporate. I think on the retail side, what has to be taken is taken, and unless and until there is another shock which comes in due to COVID, I think from Q1 next year, we should be well on our way to normalization.
What is your definition of normalization? Higher than the industry, at par with the industry, lower than the industry?
So Nukunj, you have to see us in a very different light. During these worst times also, if you look at our gross NPA, I don't think we were worse off than the industry. If you look at a peer bank comparison, I think we were always second or third, I think behind HDFC, but I think we were never worse off than the industry. The perception about us was that we are not taking everything into gross NPA. And I'm again saying that we've gone through RBI audits, we've completely been transparent in where we are. We've taken whatever losses had to be taken. We've been conservative in our provisioning. And I think if you look at the normal times, we were 120 to 130 basis points. I think with the retail mix changing in our portfolios and with microfinance I think our normalized run rate should be anywhere between 160 to 180 basis points.
Two differentiated businesses, exposure to autos, CVs, and microfinance. different ends of the spectrum. One is a play on great economic recovery, second is a play on bottom of pyramid. The bottom of pyramid end of the market has suffered. What's your sense on that end of the portfolio?
So, first let me answer two different businesses. Yeah, I think there are three different businesses which sit within the bank in addition to the business as usual, and we call them domain specializations. So, if you look at our vehicle finance portfolio, like you rightly said, I think 30-year-old business, loyal customer base, and has seen very different cycles of ups and downs, and has come out, and this time also has come out looking very, very good. If you look at microfinance business, an 18-year-old business which we acquired last year, I think the business continues to do well. It's a 20,000 crore book at a 19.4% yield. We are different in that business because I think the way we have diversified our portfolios, the way we do a textbook approach to our credit, and we don't have exposures of more than 10 to 11% in any state, and within a state we have exposures defined for each district. And I think we've come out looking very good, whereas the industry has seen elevated delinquencies. We have been very proactive in managing these delinquencies, and we've seen delinquencies which are far more manageable. Let's take the eastern sector, and I think people were expecting a huge blowout in the eastern part of India. I think we did not have exposure in Assam, very less exposure in Assam. In West Bengal, we had started reducing an exposure 1 year back, and we had reduced our ticket sizes to 12,000 rupees from a normal 28,000 rupees. So I think that worked for us very beautifully, and I think while we saw 70% collection efficiency in the month of September, it moved up to 90%, and today as we talk it's 95%. So I think we have continuously been very proactive in portfolio management. We've been, I think we have a very professional management which deals with the business. We take calls on our business very early, and since this business has been in the play for 18 years, people do understand how to manage and how to run this business.
The volatility in your stock, Mr. Kathpalia, is out in the open. Markets lost heart post the LNFS crisis. For a bank which was trading at a price to book of 3.5 to 4 times, came almost sub 2 times, even below 1.5 times. Why do you think that happened?
So I think there are 3 or 4 reasons, and I think first of all, I must say that we run a fantastic franchise, a very good franchise, and I think my predecessor left a very good franchise. What happened was, I think we were not conservative on provisioning, and that's a learning, and you would have seen that we've become very conservative on provisioning. That's one. I think we took exposures which were large exposures, and I think I believe that that was the reason why the market started discounting us. And the granularization of liability franchise was a critical element which was missing in our business. And the market said that there are issues on both sides of the balance sheet. So there were some bulky exposures which they were aware of, where we had not maybe taken the provisions, and our exposures were large in compared to the industry. And the second was the granularization of the liabilities, and the market was not very comfortable with the way our liability franchise was running.
A bank of your stature should have a ROA which should be ideally above 2%, but it should be in and around 2%. You're nowhere there. Next 2 years, will that happen? Because now you have the tailwind of economy.
So if you look at ROA is a derived number, and I think you have to see what all influences the ROA. First is, of course, the asset growth, and I think we've always said in our domain specialization businesses, we will be ahead of the market and maintain our market share. So to maintain our market share, and I think all these 3 businesses constitute 49% of our book, and I think these are businesses which have stood us well, and they are very high yielding businesses. Number two, I think the cost of funds. We are higher than the market on the cost of fund, but so are yields higher than the market. And in my view, the cost of deposits continue to go down. We've reduced 77 basis points over the last 3 quarters, and we are on the journey as we granularize the book that the cost of deposits will continue to reduce. The PPOP margin, which is an important determinant of profitability, our pre-provision operating profits is greater than 5.5% today. It's around 5.78%, and that's a very, very healthy percentage. And we are maybe behind one bank, but we are very well ahead on the pre-provision operating profit. I think we were conservative in our provisioning, and like I said, if the normalcy returns to our provision, and I've told you the range which we believe our credit cost should be in. You can calculate our ROA, and I think we should be well on our way. We have to just wait and watch how the next 1 quarter or 2 quarters plays out, and you should see the bank being well on its way to deliver what it was supposed to deliver.
What is stopping you from getting your CASA numbers high? With so much of liquidity floating around, with so much of money moving from PSU banks to private banks, it's a trend which others are capitalizing on. Why is your cost of capital still very high?
It's not about, I think during COVID times, we had to give higher interest rates. And at that point of time, we had lost some money from the government deposits. You are well aware of it, about 11,000 crores went out. And these were in savings accounts. These were government monies, and they went out. And we had to manage the book, and we gave a higher interest rate on the term deposits, because the only way you could contact the client during COVID was to get him into the term deposit route, and that's what we did. As we talked last quarter, we grew our savings account book. We grew 5% quarter on quarter. 5% quarter on quarter on the liabilities, and 11% quarter on quarter on the savings account book. And you will see that growth coming back. I think that's where we are focused on the granularization. But we will be range bound on our CASA ratio around 40 to 42%. And I think that's where we think that a bank of our size will be. I think there will be a peak which will happen maybe in the next 2 to 3 years once our digital foray comes out, and we should then re-rate our CASA ambitions. But today we are in the range of 40 to 42%. We are at 40.2%, and I think we may go to 42%. And I think our cost of deposits will continue to come down as a consequence of that.
Markets are waiting for the conversion of the promoters, Hinduja, into the banks. I understand there's a procedural issue there, but do you see that getting converted before February end?
No, the final date which the SEBI has given to the promoters is February 18th. And I am very, very sure that the logistic issues are behind, and on or before February 18th, the money should be in, as has been informed to the stock exchange by the promoters. This will increase our capital adequacy ratio by 75 basis points, and 2,000 crores does come in. As a consequence of that, they are taking the stock at 1,709 rupees. So that builds in a confidence in the market that the promoter is behind the management and their actions.
You mentioned something very interesting which we don't refer to, your domain expertise, which is now almost 49% of your total business. Are there any domain expertise which you're planning to add? Vehicle finance business is your old business. Microfinance and perhaps the gems and jewelry business are businesses which have been incubated in last 5 years. Is there a new frontier which you're planning to open, which could be another domain business, and that may just take your domain expertise %?
Yes, you're absolutely right. As we talk, we are evaluating two. I cannot speak about it. There are two domains which we are evaluating. One is there is something in the affordable housing segment and something on the wealth management side of the business, and we are evaluating these two domains, and we want to be we want to be in the top 3 in these domains. We always believe domains give you pricing power and client loyalty. And that is exactly the reason why we've gone through this storm without being affected in the credit cycle as of now.
I want to just bring this point out on how your regime you think will be different from your predecessor. While Mr. Sopti has created a fantastic and enviable franchise, I remember when IndusInd Bank, when he took over as the managing director and CEO, where was IndusInd Bank versus when he retired, the size and the scale was completely different. What did he whisper in your ears before he retired?
So I think you're absolutely right. I believe we have a fantastic franchise, and I believe the Bharat Financial has only added the feather in our cap as a domain expertise. We believe there are 4 or 5 agenda items which we have listed down as our core as we grow our business. I think scale with sustainability. I think sustainability is very important, and I think we've learnt it the hard way. And scale with sustainability is our theme for the PC5. We work on planning cycles. Granularization of deposits, and you will see us being very close to the top 3 banks as far as granularization and retailization of deposits is concerned. We believe that our domain expertise will continue to gain market share, and we will continue to create market share. I think reorienting the corporate book doesn't mean we will not do corporate. I think reorientation of the corporate book, we believe corporate bank is a fantastic business, a huge value creation business, and our bank was created on the foundation of the corporate bank. And I believe that corporate bank is back, and it's coming back in a big way. And we are working more towards working capital and more granularization of exposures, and that's what you will see in the corporate bank. Risk management and portfolio management is a key enablement for the corporate bank, which we are putting in.